We're going to kick things off with office. I'd like to welcome our distinguished office panel to the stage. We have Ashley Powell as president with PRI, who will be moderating. And then as panelists, we have Kip Paul, vice chairman for Cushman & Wakefield, Jamie Marsh, vice president, JLL, Dusty Harris, senior managing director for Hines, and Jeff Palmer, executive vice president with Layton Construction. Office panel.
Thank you very much. That'll look normal. We have a couple of people that are still being mic'd up, so I want to start by thanking my good friend Darren for painting a very broad picture for us about the world, the United States, how Utah and Salt Lake City fit into it. We're going to drill down a little bit more and talk about office specifically. And we have one more person joining us. We've got a fantastic panel for you today. In Jamie, we have one of the leading leasing experts in this area. In Kip, we have one of the absolute best investment or capital markets brokers. We have Dusty, who's a leading person with Hines, an office developer, and Jeff joining us from Layton Construction. The attempt today is really start macro and go micro. Jamie, if you could, set the stage for us by telling us a few salient facts about the office market.
Sure. First, I want to thank NAIOP for making my dream of being suited up on the floor here at the Vivid Arena possible. I'm not in a jazz uniform like my 12-year-old self thought I would be, but either way, I appreciate the opportunity. The office market finished strong at the end of 2019 and remains really active. High demand from local and national tenants is really pushing us into the new year. Ultimately, our fundamentals are really sound. Construction volumes are at a 5-year high. Lease rates increased by a healthy 3.9%, and vacancy increased slightly to 9.4%. Bolstering those fundamentals, there are a few things that really are helping. The quality of life we have here in Utah, the pro-business environment we have, and the tremendous job growth we've seen over the last several years. Looking forward, we are late into the longest expansion in history, but all indicators suggest continued but measured confidence going into 2020.
Well, that's great. That sounds very optimistic. As you say, we're late into this cycle, Jamie. And let me turn to Kip. We have talked that 2007 was the top of a prior market cycle. We're enjoying an incredible boom, Kip. What's different now than in 2007?
Thanks, Ashley. I'd first just like to let everybody know I was able to park in Donovan Mitchell's parking space under the building. I'll start with what are the four most dangerous words in real estate. It's different this time. In 2007, we were all about the pro forma. That's how we marketed and sold properties. Fast forward to today, everything's based on what's in place. I think buyers, sellers, brokers, lenders, everybody's much more realistic and accurate in how they underwrite properties, specifically with regards to tenant improvement costs. Forever and ever, we underwrote $25 as a TI for tenant improvements. That's now pushed off the side, and we now customary to underwrite $40, $50, $60, $70 per square foot. And I think all of this makes for a much more stable and accurate market. It reduces the conversation and the negotiation down to what is an acceptable rate of return. All that being said, we all have heard we must respect the cycle.
Right. So, Dusty, Hines is a global operator, and you personally cover more markets than the state of Utah. So when you look in your day-to-day job in Hines as a company, how do you think others are viewing Salt Lake City?
Well, I do spend time in other markets in Sacramento, Portland, Reno, and we have Idaho in our jurisdiction as well. We're spending most of our time here in Salt Lake City, and we have projects in Portland and in Sacramento underway as well. we spent a lot of time talking to institutional investors, and I can tell you that institutional investors think about Salt Lake City very favorably. It's interesting, 10 years ago when I moved here, there were virtually no institutional investors in sight. I was dialing for dollars on every deal I could find, and we could not find institutional capital. Now the problem is they can't find deals. And so I think they're looking at it very favorable. I expect that to continue. Two things I think that exemplify this. Number one, last year there were a bunch of suburban office deals, and there's one underway now that shows institutional capital is embracing not only Salt Lake, but suburban office, which out of the last downturn, suburban office was kind of one of those things, is a bit of a pariah, right? So I think it's showing that investors are really embracing Salt Lake City. The other thing I think is interesting is just the need for scale. I think the more large properties there are available, the more institutional investors you'll see here in Salt Lake City.
That's great, Dusty. And Kip, as a major player in this market, you're talking to everybody who's local and you're talking to everybody who comes into town. How have you seen a change in the buyer profile of people entering this market, and who's coming to town?
Oh, the buyer profile has changed immensely over the past years. When I was a young guy, we'd get a number of institutions that would come to Salt Lake and say, tell us why we should invest here, and we'd try to give them our best pitch, which apparently wasn't very good because not very many of them came here. And now I'd say that's exactly flip-flopped. The number of institutional investors, their general statement is, we are a data research-driven company. We have to be in Salt Lake City. What do you have to sell us? And our response is, frankly, not very much. We generally don't have enough product to sell.
And we have a slide, and it's hard to see them. There we go. This has some of the names of people, Kip, that you're talking to. A bunch of these names, I think, are people that would not have been here even 3 years ago, 2 years ago, and they're some of the largest institutions in the country.
Yeah, absolutely. A lot of household names. Invesco, New York Life, Starwood made a recent acquisition here. These are all great entities, and what this really provides for the market is liquidity, because these institutional groups are not just thinking about their acquisition today, they're thinking 5, 7, 10 years down the road, who's going to be my next buyer? And having this number of institutional and sizable groups in the market gives them a lot of confidence to continue to invest here. And to tag on to Dusty's remark, the fact that they're not just focused on core CBD product, they're willing to buy in the suburbs, enhances that liquidity.
Correct. Jamie, as I have the privilege of traveling around the world to major office markets, I think one of the trends that I've noticed is the amount of take-up of space by groups like a WeWork, right? I think they're the largest absorber of space in, say, a London or any other major market in the country. How's that phenomenon affected Salt Lake City?
Yeah, co-working space has really moved from a niche segment to more of a mainstream staple in our market, and it's growing really quickly, 23% annually since 2010. Right now, it doesn't make up a large portion of our market. It's less than 1.5% here in Salt Lake. Nationally, it hovers around 5%. But JLL Research predicts that by 2030, that could be as high as 30%. So a pretty big jump. There's a couple reasons why it's so popular. Growth companies now have access to beautiful Class A buildings, move-in ready, spec suites that are ready to go. And what that does is it really limits the amount of capital they have to output up front. The other benefit of flexible space is really the flexible lease terms. Tenants can scale as quickly as they need to, stabilize, and then really get ready to go to the market to do a long-term, potentially more traditional real estate deal. Obviously, WeWork is a major player in this arena. IWG is as well. They're the parent company of Regus and Spaces. And then I'll add industry to that here locally. They're another major player. But more operators are coming online all the time. And they're really focusing on a full-service platform. They don't just offer conference room space, they really integrate a hospitality component. And that's really important because user experience is absolutely key, because companies use that to ultimately recruit and retain their talent. So it's absolutely key. On the flip side of that, how do traditional landlords compete in this space? We've seen success in a couple areas where building owners will actually open and operate their own co-working space within their building. We're also seeing landlords build out spec suites where they can control the costs and they'll put in a layout that really works for a lot of different tenant types. And by doing that, they can compete with the short lead times for occupancy for these groups. But absolutely, there's no doubt about it that co-working and flexible spaces have really changed how occupiers consume space in our market.
So do you think it's an overall positive for our market?
I do. I think there's a space for it. I don't think it will ultimately change how we do real estate. There's a place for it.
Now, we've all read about WeWork and its founder, Adam's difficulties. Let's say they go poof in the middle of the night. Yeah. Does it really affect our market?
They're a big player here, but there are so many operators coming into this space that confidence is still high, that with the change in management and everything they're doing, in fact, there was a news article yesterday that they sold off a couple ancillary divisions. So they're really changing their model. They have new management, and they're focusing on getting a path to profitability. I do think that'll happen, but that's kind of the high level. When you look at it here locally, their occupancy levels are actually really high. Gateway 1's at about 80%, and then Innovation Point in Lehigh, they're at about 95%. So I think it bodes well for the future that, it's a long way for them to go to get to profitability, but I do think they're making big strides.
That's great. Dusty, Hines, being a global operator, has a chance to see trends, identify trends all around the world. Which of those trends are you seeing translating here to Salt Lake City?
Yeah, okay, so we are talking about this a lot. I think the office market, Hines is known for office development. We are active in all product types, but office is sort of what we're known for. And we're talking a lot about the changes. And so I thought a few of these things that we're talking about a lot would be interesting to the group, and I do see them here, and I'll give you some examples. But number one, the core stock of office properties is aging. So that basically means what is trophy today may not be trophy tomorrow, right? And this is particularly true when we think about sustainability and creative workspace. Number two, disruptive technologies. New technologies accelerating obsolescence and change. Number three, emergence of real estate as a service, and this is really what Jamie's talking about. We view co-working and flexible workspace as a service, but this really means that tenants are demanding the flexibility, more amenities, and more services. Number four, demographic shift in all markets. Millennials are now the driving force behind real estate decisions. In fact, I found this fact that I think Hines believes in, which is in 10 years, 70% of the workforce will be millennials. And so think about how that changes demand for office space and what they want. Number five, urbanization. These are new patterns of growth that are creating winning secondary markets and new submarkets, and I think a live example of that is the Granary here in Salt Lake City. So really, these disruptors are impacting the way we think about everything in relation to office space, and here are a few examples I think that's showing that the industry is thinking about it as well. A couple things just this week I thought were interesting. Morgan Stanley and BlackRock have both recently signaled a willingness to accept lower returns for sustainability in their investments. And then yesterday I read a thing from Steve Schwarzman of Blackstone, who said that companies, in his view, have an obligation to address climate change. And so I think sustainable buildings are not only the right thing to develop, but will be in higher demand by both tenants and investors going forward. As it relates to aging stock and services, significant capital across the country is being invested in older buildings. Just locally here, we're finishing up a $25 million repositioning of our Kearns building on Main Street. Many of you may know that asset. It'll be finished in the spring. And by the way, thank you to Jamie for bringing plaid to the top floor. We had one of our senior partners in from Seattle this week, and she went to see the space, and she said she thought it was the coolest space she's ever seen.
It's phenomenal.
So
it is.
It's pretty exciting stuff. But we took measures to get this project, which is over 100 years old, in a state that we can qualify for LEED EV. That takes a while, so we won't know for a bit before that happens. But and then the other thing is, Jamie mentioned that some landlords are rolling out their own versions of WeWork. We are rolling out our own flexible workspace. We call it Heinz Squared, and that is going to be introduced at the Kearns building on 2 floors. That'll be open in May, so we're excited for that as well. And just a note on sustainability, they are seeking the WELL certification there. And then just 2 other thoughts. All the product that Heinz is developing is either timber or creative architecture to appeal to millennials and the changing demographic. And then perhaps we can talk more later about urbanization and what we're doing in the granary, but throughout the country, Heinz is looking for opportunities to invest in these pockets like the granary. And a few examples of that are Rhino in Denver. We're about to kick off a timber building. Portland's east side, which is one of my markets, we have a site for 2 T3 buildings. T3 we refer to as, that's our heavy timber product. And then Nashville's WeHo, and I mentioned our very own granary. So,
well, that sounds very positive, and I think everything we've shared so far would tell you that it's a pretty good office market. You got a lot of influencers that are coming, that are generated in other parts of the world, but are manifesting themselves in a big way here. Let's flip it a little bit. Jamie, what's the biggest challenge facing our market?
I would definitely say the tight labor market, and then I'll add to that affordable housing.
Okay.
And what I find interesting about those 2 is historically those have been seen as strengths in the Utah market, but as those continue to tighten, it's really presenting challenges to how we move forward with growth.
And Dusty, same question.
yeah, I would agree with Jamie. I think it's labor availability, but I would also add to that diversity. I think we have pursued some tenants that have chosen other cities, actually, instead of Salt Lake City because of our lack of diversity, and I think that's changing, but I think that's a constraint.
So labor and diversity. Now, when both of you are saying tight labor, is that about qualified office workers, or is that about people qualified to be able to build and erect the projects you want to do?
I think we have a highly educated, well-qualified workforce. To me, the question is more, do we have enough bodies to fill all of the jobs that are coming to Utah?
Right. So 2% unemployment, that's a historically low number. Jeff, let me turn to you. With latent construction, there are a lot of large projects going on in Utah. Facebook, the prison, you name it, the airport. How's that affecting what Dusty and others want to do?
Well, exactly what they said. I know a lot of you have had a chance to tour Facebook, tour the airport. That's an easier one to see, as well as maybe the prison. And if you get out there to those job sites, you realize it's a small city. It takes hundreds and hundreds of workers out there every day. So just like Jamie and Dusty said, it's putting an extreme strain on the labor market. And what does that mean? In the past, Utah could draw a lot of labor from surrounding states and throughout the country. Well, the country's experiencing the same thing Utah is for the most part. So our subcontractors can't get the labor as easily as they once have. And our local contractors are competing against the incentives that like Facebook is offering to electrical subcontractors. So it puts a strain, and people have to respond with that with higher wages just to keep the staff that they have from leaving. I talked to one mechanical subcontractor, and he says, number one, he's one win away from being off the market for 2 years. That's how much work he has. And then also, he had to increase his salary 3 different times in 2019 just to keep his staff that he did have. So cost goes up because salary's increasing, but it does also bring new opportunities. We're seeing more introduction of technology in the construction field, so people can do more with less. Prefabrication of materials requires less staff on site. And then just different materials that require and are easier to install.
Okay.
But if you look at Facebook, the airport, the prison relocation, it does create a lot of opportunity for future economic growth. So I don't see the problem going away anytime soon.
So 2 quick questions. Is it true that some people will give a $100 bill to electricians or other employees just for showing up on the job?
I've tried to show up. They didn't give it to me, but I've heard that is true. They offer them food, overtime, and additional cash incentives. So that does make other electrical contractors hard to compete against that.
Right. Now, there was a great slide that you had put together that showed construction costs. I'm going to try to put it up on the screen for people. And then can you tell me if you believe the numbers that are on that slide?
So the slide that I assume is being shown is more of a historical. And as you can see, it naturally tends upward, unfortunately, to many of us trying to make a budget. But it does show it going down a little slightly in 2019. I don't know if that accurately reflects Utah. I don't know how many of you have experienced a cost reduction on your projects. We haven't necessarily seen it. So in preparation of this, I know everyone wants a crystal ball. Where is construction costs going in 2020? And I found it interesting. So I reached out to many of my contacts in electrical, mechanical, and steel, kind of the main players that have a significant portion of the budget. And I found that they're not sure as well. For example, I talked to electrical subcontractors. One said they see a typical 2 to 3% increase, while the next phone call I spoke to someone saying they saw a 5 to 7% increase on labor and a 7 to 10% increase on equipment. Right. So electrical may play out. We'll see where it falls. And then on mechanical, I've been told to expect a 10 to 15% on equipment for mechanical. Then on steel, I was on the phone. There's an article in E&R magazine. E&R is a construction trade magazine that's well respected. They're predicting steel may go down maybe 6% in 2020. And I was discussing that with a steel subcontractor. He said, yeah, maybe. We'll see where it goes. And as I was on the phone with him, he got an email from Nucor indicating that steel went up $25 per ton. And that represents the 5th increase in steel since October. So we'll see where it plays out. If I had my crystal ball, hopefully it all averages out to a 2 to 3% increase for 2020 and 2021.
So Jeff, you've hit on the fact that that this is spreading, right? We can't import labor from Las Vegas or somewhere else. It is spreading across the state as well. Jamie, maybe you could talk to us a little about Silicon Slopes and other places where you're seeing that activity manifest itself. And I'll put this slide up so people can see it.
Yeah, absolutely. Tagging into what Jeff was saying, I think construction was a major theme in 2019. Construction volumes are at a 5-year high, with 2.8 million square feet being under construction in the 4th quarter of last year. That's a 200% increase year over year. So growth in construction are happening in a lot of pockets in our market, but it's really concentrated in 2 general areas. Downtown, with the emergence of 95 South State, and the Silicon Slopes, where right now there are 8 Class A office buildings over 100,000 square feet under construction right now. Interestingly, those 8 buildings are 62% pre-leased. And I think that's a really good indicator of the demand that we're seeing and the healthy activity we still have in our market. When you're comparing those 2 markets, downtown and the Silicon Slopes, they're certainly apples and oranges. But one thing they do have in common is their access to mass transit and amenities. Competition for labor is so fierce these days that if you're a company located on a track stop or a front runner station, you've really broadened your ability to recruit all over the Wasatch Front. And I think that theme will continue moving forward into projects that are coming online this year and in the coming years, that you'll see these projects being well located along mass transit corridors and surrounded by amenities.
Yeah. Kip, suburbs, downtown. Would you personally invest in either one or both?
Good question. I think they're both distinct markets, and I think they're both flourishing. On one hand, you can say in 2019, 90% of the absorption occurred, of the total absorption occurred in the suburbs. On the other hand, if you look at true rent growth over the past 5 or 7 years, I think downtown has had significantly more true solid rent growth as opposed to the suburbs that have been perhaps a little flatter. And I think the reason for that is you have, I'll call them the big three developers, Gardner, Boyer, Stack, out in the south end of the valley that have substantive land holdings where they have a low cost basis in the land. It's a very competitive environment. I think it's held those lease rates down. My personal belief is I think we'll see a pop in lease rates as land gets absorbed, as we see construction costs continuing to rise. I'd also suggest that the leasing agents, office leasing agents, think in terms of cost per seat as they deal with their prospective tenants, as opposed to just cost per square foot on the lease rate. That's certainly how the employers are thinking. The other big factor in that discussion is I'll call it the risk profile of developing buildings. It's a much smaller risk to go develop a 150,000 square foot building in the suburbs as opposed to building a 450,000 square foot building in downtown. Just a longer construction cycle, longer planning cycle. Which actually brings up the question of if we would have had more lease space downtown, would we have had more absorption? My belief is yes. We've currently got in the pipeline about 1 million square feet to be constructed downtown. And I actually just got some statistics here last night. Our projections are, and this, I'll give Michael King and our research department credit for this, we believe there's going to be about 2.3 million square feet built in the downtown area over the next 5 years. If the job creation and the same percentage of those jobs go to office jobs as we've historically seen, granted a number of assumptions here, our office vacancy rate in Class A downtown will drop to 2.5%. That's very, very tight. To keep a sub 10% vacancy rate, we'd need to build an additional 1 million square feet over the next 5 years. So, and then I'll lay one more layer onto that. If you back up 10 years ago, and this is an arbitrary ratio, but we had 35,000 square feet of Class A office space to every one Class A apartment unit. Fast forward to today, that ratio is now 2 to 1. We now have 2,000 square feet of office space for every Class A apartment. And we've certainly learned that apartments and office space go hand in hand. People want to live close to where they work and vice versa. So I think the stage is set very well for the need for further development of office space in the downtown area.
Well, that's a pretty amazing statistic. If office vacancy got down to 2%, to put it in perspective, I think Paris today is sitting around that. The 2% is half of what the national multifamily vacancy is, and multifamily has historically had a much tighter vacancy factor than any other product type. 2% is an astounding number if we were to get to that. What would happen to rents if you did that?
They would tend to go up quite dramatically. I'd also just say I heard, to add on to what one of Dusty's main points, I've recently heard Salt Lake City described as a teenage Denver, and I think that's a great compliment because we all know teenagers are much cooler than the adults. But the coolest teenager in the room is granary. I think we're going to see over $1 billion of development there in the next 5 years, and if you're an employer, trying to relocate employees from San Francisco and Seattle and Los Angeles, and they're these young tech type of oriented employees, they want to be in an area that's got a little bit of grunge to it and a little bit of hipness to it, and that's certainly what granary is, and I expect that area to really boom.
Let me pivot to Dusty. You guys have seen that vision. What are you doing there?
Yeah, first of all, I'd say there's no way the developers in this room are going to let vacancy go to 2%. That's not happening. And we're going to do our best to contribute to that as well. And on that note, we, in partnership with Century Financial, Jonathan Ruga and Peter Caroon, we have approximately 10 acres of land under contract in the granary. And a huge thanks to Kip and his partner Red Boo for this. That we were able to assemble, I say we, but really Kip and Rhett were able to assemble land, I think from 6 different owners, and that was a Herculean effort by them, and we really appreciate your efforts there. But if I can just share, we're sitting in this arena, and I can't help myself. I had this experience as a little kid. I grew up in a small town in Idaho, and word got around that Karl Malone was coming through town. He was going to drive his diesel truck through this fast food restaurant. And so my buddies and I went down there, and we were standing in this line, and this huge crowd seemed like forever. And I got impatient waiting, and I went in the restaurant. I actually went in to use the restroom, and I'm walking out of the restroom, and I open the door, and there's Karl Malone. It's like the mailman. So I won up the entire crowd just by, going inside. And what does that have to do with real estate? Probably nothing, but
Great story, though.
It's a great story. And I think what it might have something to do with is we just really firmly believe that it's only a matter of time before tech companies start to take space in larger doses here. And some of the tech all-stars, the big boys, they've dipped their toe in. We think it's going to happen in a way that we've seen in these other cities where they start to take larger chunks. And we want to be there with product ready when they get here. And so this may chill the market a little bit. We have 1 million square feet of office under development in various phases right now. And incidentally, we have 1 million square feet of industrial, and we have 1,000 apartment units as well. But the office product, it's a high-rise on Main Street between 4th and 5th South, world-class architect Picard Chilton, and we're really excited to show the renderings of that project. We have 2 heavy timber buildings in the granary slated, and that would be 420,000 feet. And then this spring, we finished the redevelopment of our Kearns building, all creative office space that we're really excited about.
All right, let me just jump in there. Yeah. When we conceived 95 State as the newest building downtown, one of our big goals was bring tech downtown, because we think that we owe it to the young talent within Salt Lake City to be able to do that. Let me go, because we're running out of time, just to a lightning round here at the end. Jeff, I'm going to start with you. What is any parting words of wisdom to the crowd?
Wow, I could take all day. Thanks,
Nope.
Ashley.
You get one sentence.
Plan ahead. Use the resources you have. Get a good, solid team, architect, contractor, and subcontractors around the table to increase your predictability on cost and labor.
Great.
I'm not sure I have any advice. I would just say we're trying to mitigate our risk by capitalizing for long-term hold. And so that's one thing we're doing.
And meet Karl Malone.
Yeah, exactly.
Yep.
I think we need to think differently. Rather than designing buildings that are going to last 30 years, we need to design buildings that are going to last 100 or 200 years. They need to be sustainable. They need to have great architecture. Great architecture is what makes great cities. I think that's my parting thought.
Fantastic. Jamie?
I don't know if it's words of wisdom, but I'm really bullish on the Utah market, and I think buckle up. There's a lot of things coming down the pipe.
Terrific. Back to you, President.
We are up for questions, and please remember up on the slides, it tells you how to ask those questions. If you could text those to me, we'll get them going. We already have questions coming in. The first one, and thank you for your words so far. First one is actually for Jeff Palmer. With these cash incentives and things like that are happening to the labor market, what do you say to the other trade partners that are already increasing their wages to match other markets outside of Utah? How do you have them scale that with this market here?
That's not necessarily up to the general contractor for the most part. It's up to the project. We have not done that on any of our jobs. The prison may end up having to do that. That's under discussion. But the subcontractors have to do what they have to do to compete. You'll see more subcontractors go out of business in a good economy rather than a bad economy. And so we just have to do a lot of verification of their financial stability, as well as make sure they have the staff available when they commit to a job. And that's a difficult task to do. But in terms of the incentive portion, I personally don't have much experience with that, but it's a project description. Facebook obviously has more money to throw at problems than most jobs that we're, as a community, tasked to build. So it's a little different scenario there.
It is out there as a trade partner
You feel
myself. It's out there. Okay, next question is for Jamie. Do you think the CBD will be stealing tenants from Silicon Slopes?
It's an interesting question, but I don't think they compare. It's apples and oranges, and tenants that are drawn to Silicon Slopes are drawn there for different reasons than tenants that are drawn to the downtown. The groups that are interested in downtown really like the urban feel, the walkability, access to bars and restaurants, and the groups that are looking in Silicon Slopes, the lease rates are a little more flat, it's better deals, and there's greater access to land out there. So growth they can accommodate. If you're outgrowing the buildings down there, they can just build a building right next door. So I think it's apples and oranges. I don't think it's necessarily that they'll be stealing tenants. I think there's room for both, and it just depends on the users and what's important to them.
And as we look at these lease rates continuing to increase as construction costs go up, are the tenants going to be willing to pay that? And that's for anybody on the panel. Ashley, feel free to direct that.
Well, I think our lease rates at 95 State, when it's all said and done, will be $10 a foot higher than 111 Main, and 111 Main set a record in its time.
I'll add to that,
Please.
that when we're touring tenants, price has never been an issue that wouldn't get the deal done. A lot of these companies are coming from the coast, where rents are significantly higher than Salt Lake City, so it's still looked at as almost a value play, even though rents are pushing higher and higher here.
Here's another question. How do you see the prison relocation and the opening up of the point of the mountain affecting new development, vacancy rates, and lease rates?
Is that for me too?
That's for anyone. Dusty, why don't you take that one?
I mean, I think it really affects the industrial market, which we're busy in. I think might the airport area have more stock developed out there potentially. I just don't know if the rents are high enough to justify the cost of development. So I'm not sure it has an immediate impact on office stock would be my off-the-cuff answer.
This one is for Kip and Dusty. How are the institutional investors viewing our local credit tech companies and business parks such as Thanksgiving Station?
Well, clearly, Thanksgiving Station just changed hands here recently, and the tenant profile there was a number of smaller tech tenants. I think keeping an eye on the credit of some of the smaller tech tenants is certainly something that would be a smart mindset to have. So no effect yet, but it's certainly something to watch.
And what are your thoughts, and raise your hand if you feel you have an opinion on this one, what are your thoughts on office space in Davis and Weber County? Will they see the same type of rapid growth that Salt Lake City and other areas have seen? Ashley?
I would tell you we were just approached by a very large company whose name starts with the first letter in the alphabet about land that we have to the north.
Do I have it in my pocket? You can't say
might.
that. Okay, and how do you see dealing with parking? This was probably for Jamie. How do you see Utah dealing with parking as the CBD sees dramatic growth over the next few years? And what does the market expect for parking in office spaces?
It's an interesting challenge because users are densifying more and more. They're getting more efficient on their floor plates, so their loads are a lot higher. So parking is an issue. Everybody wants to be on mass transit, but we're not seeing RFPs that show lower parking ratios. Everybody still wants really high parking, so I think it's just going to be an added cost into the new developments that come online downtown where we have to plan for parking garages.
Can I weigh in on this?
Please, Dusty.
Really make a plea to the brokerage community in the room. All these other cities that we're doing business in and we're seeing become really cool and lots of development, the parking ratios are way less than what we have in Salt Lake City. So the natural path of things, I think, have to go to lower parking requirements. But like Jamie said, every RFP is still very high. And so I'm not sure what the catalyst to change that is, but I think it has to move in that direction.
Yeah, I've always thought that parking stalls cost us $50,000 a stall, and it's very tough to get a payback on that. And we're looking at a building in another city right now, and they told us, no, parking's really closer to $100,000 a stall. it's almost impossible to get a payback on that.
Kip, how are cap rates here for office comparing to the national average we saw earlier of approximately 7.25%? That's a very specific question. Thank you.
Our cap rates here are relatively attractive compared to some of the competing cities, particularly cities on the West Coast. Our cap rates are getting compressed, but we're still able to offer attractive returns, and that's why investors are coming here.
And with the construction costs going up, how does that affect the performer of your different buildings?
Well,
I'd like to hear from Kip, Dusty, and Jamie on that one.
Well, I think we're right around the corner from seeing, I'll call it a $600 per square foot office trade. When you look at the rates that are being achieved at 95 South State, and the demand for top tier quality, particularly in the CBD, I think you'd see a 5 cap rate around the corner. That's going to translate to $600 per square foot. Couple that with the increase in construction costs. Add on top of that the increasing land costs. The most recent CBD land trades for a D1 zoning are above $250 per square foot. But to keep that in comparison, the equivalent in Denver is $400 to $600 per square foot.
Dusty?
You want to hear from me? I almost want to give you a hug after you said that. So
Go ahead.
you know, I echo that. I think the pricing's got to go up to justify all the costs of development.
Jamie?
I'll echo the same thing, and that just say again that so many of these companies that are coming from the coast to Utah are still seeing this as a value play compared to coastal rents. So they do have to go up, and I don't think it's going to significantly impact our demand.
And Jeff, on the construction side, you see these costs going up. How hard is it for you to stay within budget as projects are in design and pre-construction mode?
It's extremely difficult, and there's mechanisms such as contingency to manage that. I think we can handle increase. It just has to be predictable increase. When you get the sudden bumps, like the tariffs all surprised us a while ago, no one knew quite how to handle that. But a steady increase and maintaining the pulse on the market is extremely important. And that's why it's even more important to have everyone around the table to anticipate that. You have your mechanical subcontractor sitting there letting you know if he sees something in the design or in the market that's going to impact the future. Now you have that during the design phase so you can plan for it. It's the unexpected surprises that keep all of us up at night.
Excellent. Ashley, any closing remarks?
No, thank you very much. It's a privilege to be here. And let's give a hand to our panel.
Thank you, everyone.